Hello everybody. Firstly, I'd just like to welcome you to this webinar. We'll be talking about the US dollar and the most important event of the week, the non-farm payrolls and the opportunities its publication will present. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm delighted to have you with us. If you have any questions, please call us and ask to speak to a senior account manager. We'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And now, let me explain what a market opportunity is if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. And you can see an example of a very recent market opportunity. Here you can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-US dollar currency pair. For example, the part on the EU and its disagreement with the Italian government over its budget, which has put pressure on the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the right-hand side of the screen here, this shows the right moment in our estimation for opening a trading position, had you decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit, and further down you have calculations. If you close the position using take profit, you can expect these kinds of profits at these support levels in green. If the price is going against you, then you can potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. First off, let's take a look at where the dollar stands at the moment, and we'll briefly take a look at the main factors influencing its current value. As you can see on the graph, the dollar was in an uptrend over a basket of other currencies over the past year. This partly has been due to weakness in other major currencies. For example, Brexit in the UK has seen the pound fall, and softness in the Eurozone economy has put the euro under pressure. But the strength of the US economy has helped the dollar against its rivals, as has higher interest rates. However, over the past month or two, we have seen the fortunes of the dollar reverse direction. So what's going on with the dollar? Well, put simply, the US economy is slowing down. We will see this in more detail in a moment after the publication of last month's NFP. But the point is that traders now believe that the Fed will reduce interest rates 3 times before the end of the year. Analysts now expect that the first interest rate cut this year will come as soon as next month. The dovish sentiment has sent the value of the dollar plummeting downwards. The non-farm payrolls report is the release of data on US jobs growth over the previous month, published by the Bureau of Labor Statistics, usually on the first Friday of the month. It's the most eagerly awaited monthly data by world markets. Morning trading volumes are usually slim in European markets on the day of the release as they wait the afternoon release time. The headline number in the report gives the number of jobs that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus and by how much. Over the past few years, non-farm payroll data has been very positive. Last month's figures were worse than expected, as I will explain in a moment. As you can see, the unemployment rate has significantly improved in recent years. The unemployment rate approached 8.5% during the financial crisis, but has fallen since. The unemployment rate has recently fallen to 3.6%, its lowest level since 1969. Average hourly earnings is important since an increase in the figures indicates a possible rise in inflation and in the value of the dollar, while a decrease in AHE tends to push the dollar down. Month-on-month average hourly earnings was 0.2% in May. The NFP release comes together with the unemployment rate indicator on the first Friday of each month. When this is due, the trading week is a range-bound one for the forex market, and after the release, traders start positioning for the next time the Fed meets to see how monetary policy changes in the meantime and how to react. When the actual number differs from the forecasted one, the market travels. Usually, traders take positions for the NFP in advance by looking for clues from other economic data like the ADP jobs report or private payrolls. The unemployment rate is part of the Fed's decision-making process to move on interest rates. Generally, a lower unemployment rate is better for the economy as jobs are created, and this could result in the Fed hiking rates. Higher rates lead to a higher dollar. Forex trading is about anticipating what the central bank is going to do with interest rates at the next meeting, and the NFP is the perfect economic release to position on the right side of the market. The non-farm payrolls released on June the 7th, 2019 showed that the US economy created 75,000 new jobs in May, much worse than the predicted estimate of 185,000 jobs. The jobless rate remained at 3.6 as expected. Following the publication of the release on June the 7th, the dollar fell by 0.51% by the end of trading, as you can see on this slide. The NFP result then itself was very poor, and despite the in line with expectations unemployment figures but slightly better than expected average hourly earnings, the dollar fell. Investors quickly decided that the results sharply increased the chances of a Fed rate cut by the end of the year, causing the dollar to fall. In fact, most investors expect as many as 3 rate cuts to keep the economy growing. This prospect sent the value of the dollar downwards. As far as the euro-dollar is concerned, the currency pair jumped higher by some 0.7% before falling slightly back, finishing up by 0.52% by the end of the trading day. The euro continues to suffer from weakness and high volatility due to sluggish economic performance, such as EU political and financial issues in Italy, aside from Brexit. But as far as the currency pair is concerned, a very poor jobs report is going to send the euro-dollar higher, as it did. The thing to keep in mind is that the dollar is often volatile on the day of the NFP, but that the NFP can also represent a good trading opportunity. So what can we expect for next week's report? Economists expect that the NFP will record that 160,000 new jobs were created in June, and that the unemployment rate will remain at 3.6%. Traders would also be advised to keep an eye on the average hourly earnings figures. If they are above expectations, they may push the dollar higher. Average hourly earnings are considered a sign that inflation will rise. Average hourly earnings are expected to grow from last month's 0.2% to 0.3%. If earnings are higher than expected, it may dampen expectations that there will be a number of interest rate cuts this year, pushing the dollar higher. A 4th interest rate hike last year took place in December, but the talk now is just how many cuts in interest rates there will be this year. President Trump favors lower rates, and it seems that his constant criticism of Fed officials and fears over an economic slowdown has hit home. Many traders believe that the Fed may cut interest rates 3 times this year, with an interest rate cut expected this month at the next Fed meeting. Fed officials have now shifted policy, signaling that the most likely move will be a cut in rates rather than the previous position of a purely data-driven policy. On June the 25th, Fed Chair Powell stated concerns about the downside risks to the economy, stating that the case for cuts had strengthened. As I showed, the dollar has traded lower since these dovish statements, as some investors have moved their holdings into gold and stocks, which have both recently seen record highs. In any case, it's certain that reports like the NFP can have a major influence on the greenback and the financial markets. And of course, we at Fortrade will be following any developments that affect the markets very closely. So please do get in touch with a senior account manager if you have any questions or want to take advantage of the trading opportunities that the NFP will present. Until next time, goodbye, and please join us again at Fortrade soon.